SBUX is at its 52-week low, down 13% over the last year. So is this a phenomenal time to buy this undervalued company? We're going to find out. We're going to do a deep dive in today's episode. We're going to look at their numbers, their top line revenue growth year on year, their bottom line net income as well. We also want to look at the health of this company, their total cash versus their total debt based on their latest quarterly report. We'll also compare them to others in the industry over the last few years to see whether or not they are performing in line with the industry, better or worse. We'll also look to the institutions to see if they are continuing to buy this company, if they've stopped or if they are selling their shares. And we'll also discuss some insider selling that we have noted over the last few weeks. As always, we'll look at that dividend safety, we'll look at the financial metrics that support the company and decide what the future growth of this company looks like. We also want to look at some news from today that SBUX in the Middle East are laying off around 2,000 of their workers amid the boycott calls. So we'll take a look at that, look at some of that information. And as always, we'll put them into the valuation model. We'll get to our updated intrinsic value, look at that new acceptable buy price with the margin of safety, and see if Wall Street are still seeing a lot of upside in this company over the next 12 months. So first, let's look at their historical performance. Now, they are down 13% over the last year. Over the last 10 years, however, they are up around 149%. Bear in mind, it doesn't include those dividends reinvested, and their all-time highs sitting around $126 summer 2021, nearly 3 years ago. Right there at the 52-week low, it does offer a yield of 2.5% and a forward PE of around 22.5. In terms of their numbers, now when we do a deep dive, we want to see at least 3 to 7% growth just for a steady, moderate flow. September 2019, 26.5 billion reported. October 2023, 36 billion. So two things to note here. Firstly, nice growth over the last 5 years. So that would give us a very positive sign. They are increasing their top line very strongly. On a more granular level, what we do note though is 2019 to 2020, the COVID year, where there was lockdown, the companies and the stores were shut. We do see it then pick back up from 21 to 22 and so on. So overall, a justifiable drop in 2020. Nonetheless, over the last 5 years, they have been growing their top line. And we'll look at the percentage movement shortly as well. Bottom line, 3.6 billion reported in 2019, 4.1 in 2023. So again, nice growth to their bottom line. But again, we do see a little bit more inconsistencies actually on the bottom line as it dropped in that COVID year before picking up, then dropping in 22 and then picking up again. So overall, over the longer term horizon, the last 5 years, their top line and bottom line have been increasing, but we do note some inconsistencies. Then a quick health check based on their latest quarterly report. Total cash, 2.8 billion in 2019, 3.4 billion from their latest report. So they do hold a little bit more cash than they did 5 years ago. Then we look numerically as well as directionally the total debt movement, and we know actually it has more than doubled from 11.2 billion in 2019 to 24.5 billion. So something we will keep an eye on when we look at the net debt to EBITDA metrics to support the dividend safety as well as the health of the company, as their total debt is larger than their cash and has more than doubled over the last 5 years. Now, in terms of the industry, other competitors and similar size, we have the restaurants industry, Chipotle Mexican Grill, we have DoorDash, as well as in other few well-known companies. SBUX, well, over the last year, so this includes reinvesting those dividends, they are down negative 11%. So we can see in actual fact they are one of the worst performing, and SBUX as well as MPNGY with negative return. The other companies, as we can see, have performed fairly well. So SBUX not looking great on the short-term horizon. Over the last 5 years, however, we do see them as one of the top three, up 42%, but again, not really great for a 5-year return. So again, just bear that in mind, but also important to understand that past performance is an indicator of future. Institutional ownership, 70%, around 9 billion worth of sales by the institutions over the last 12 months. Over the same period, a lot more buying, 23 billion by these institutions. And what we can note in the more recent quarter, Q4, the institutions do continue to buy. In fact, we see the largest buy in 2023, Q2. Q3, we see more selling, but what we note in the more recent period, institutions are still buying. As always though, do your own due diligence. This is just one layer of our research and analysis. So insider buys and sells a minimum 100 shares over the last month, and we can see that 2 insiders have sold some of their shares. We have the group president of the international region as well as the EVP. Now, what we know overall, around 325,000 worth of sales, and the share price has gone down since then. But remember, it's not necessarily a bearish signal as they sell for many reasons, personal or financial, but always good to include within this analysis. Now, just to let you know, we have released the latest article of our free weekly newsletters. If you want to gain access to this or any other copies, all completely free, just click on that pinned comment below. Now, before we jump into these metrics, we just want to discuss this article. In fact, from today, as we can see, that the Starbucks and Middle Eastern stores are going to lay off around 2,000 due to the boycott calls. Now, we can take a very brief look, find some interesting points. Now, we can see it is a franchise operator that runs the Starbucks outlets in the Middle East as well as the North Africa region. And on Tuesday, they did say they will lay off around 2,000 of these workers due to the boycotts to the American coffee giant linked to the ongoing war. So we do know that this has been an issue. There has been boycott calls which has affected their top line in this region. Something to consider whether or not you do believe that these boycotts will stay and will continue to hurt the Starbucks business, or whether you believe this is something that will pass with time. Again, this is something that you do need to impact and put into your investment thesis, and we will essentially take a look at our margin of safety, and that, or in fact, that may impact the percentage you are looking at. So in terms of the dividend safety score, 67, it does look to be safe. Market cap 103 billion. It is a mega cap company. In terms of the recessionary metrics, well, they didn't pay a dividend, so no comparative data. Negative 6% recession sales, above average growth, which was negative 12, but they also essentially underperformed the S&P, negative 69, versus that S&P's negative 55. Dividend growth, 7.5% in September 23. Always good to see when it is above that 4% we advocate, as that is what you need to keep up in line with inflation at a minimum. Double digit over the last 5 years, double digit over the last 10 years, very, very strong. And we do know they have been increasing those dividends for the last 13 years. Dividend yield theory, then we have that sign of undervaluation, 2.49 currently the yield on offer versus that 5-year average, and the forward PE much lower, 21.6 in fact, versus that 5-year average of 29. We do, however, note the consumer discretionary sector PE is much lower at 15.4. So as always, free cash flow payout is what we draw your attention to, as the earnings is susceptible to manipulation by management through accounting. Now, what we can see, 2022, 90%, a little bit too high. In fact, I personally prefer 60%, as that gives me faith management are able to offer those double-digit increases. We can look at below 50% if you want to be industry specific. 67% in 2023, edging lower to that 60% mark in 2024, which is what I like to see. So no worries based on this information on that dividend safety. Free cash flow as well has increased from that negative 37 cents to 2023, but do note the inconsistencies and also note that increase to 2024 expected to be 359. Pretty inconsistent overall, but as long as in the longer term you are holding a company and it is increasing its free cash flows, then that is okay. Do expect some hiccups along the way, but as always, if your investment thesis is something you believe in, then it shouldn't be something you should just sell because of 1 year there is a particular issue. Sales growth, we do see double digit nearly every single year, very strong. Remember, the minimum we want is that steady, moderate 3 to 7% growth. The last 3 years looking very strong. And on the trailing 12 months, again, showing some positive signs that the FY24 accounts will also show nice growth to their top line. Numerically, though, more than double their top line, 16 billion to 36. And when we look at the shares outstanding, 1.53 billion, they have reduced this, not consistently, but very positively to 1.15. And remember, this is essentially returning excess cash to investor pockets as they are reducing that ownership pie. In terms of the ROIC, very strong. You know, if you watch this video, we want a minimum of 10%, 33% in 2023, 29% in 2022. So very good over the longer term as well, where we do see it in the low 40s. Remember, this does show us or give us faith that the management are able to effectively allocate their capital. Operating margin above 16%, pretty much straddling around that for the large part. We do know that COVID year where it's dropped, we can say that that's justifiable, but something just to keep an eye on. But nonetheless, over the longer term, it does look like it is keeping around that level. The same to go with the free cash flow margin, 10% in 2023, looking fairly nice. Finally, then the net debt to EBITDA. Now remember, this is the earnings before interest, tax, depreciation, amortization. 2.06 in 2023, 1.89 in 2024. We want a maximum of 3.5, so this is very positive to note. And essentially, these are the number of years it would take the company to pay off all of their debt net of cash on hand, and also correlates to both the balance sheet strength as well as dividend safety, so no worries whatsoever there. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model we're looking at is the multiples valuation, companies in a similar sector and size with their P multiples. We get the average multiplied by that of SBUX to get an intrinsic value of $135. So we have that first sign of undervaluation. Just bear in mind though that we don't look at any of these models in isolation, and we will conclude towards the end of the episode. We then have the dividend discount model, the nice dividends growth over the last few years, a nice high single digits at a minimum. On average, 10%. Now, I've gone a lot more conservative at 5.75. On this model, I do prefer to be on the more conservative and optimistic side, especially as the way the majority of companies over this last 12 months have started to reduce those dividends. This gives us an intrinsic value of $107, and we can see our second sign of undervaluation. We then move on to the third model, the DCF model. Over the last few years, we have the free cash flow. Strong average growth. We've gone from around 12%, which we believe reasonable based on analyst targets and management guidance. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and we have our third sign of undervaluation. So in this case, the intrinsic value is just the average of these three models. Don't forget, you can grab a copy of this model if you want to run your own companies in your watch list, or even if you want to run through SBUX based on your own targets and estimates. So as always, we start off with that 10% margin of safety, 3 criteria: wide moat, strong financial metrics, good forward-looking data. We keep going to near the current trading price, and we can see whilst there's not a 25% margin of safety, right now we see at least a 20% margin of safety level, which indicates a fairly strong buy depending on your investment profile and your risk to reward ratios. In terms of Wall Street and what they forecast, well, over the next 12 months, they see the price going up to $108, so they see upside of just under 20%. So again, they do believe this is a very strong buy. As always though, do let me know your thoughts in the comments below. Is SBUX one you have started to nibble on at just above the $90 mark? Are you looking to wait for it to come down, maybe around a 25% margin of safety at $87? Or as some people who like to be really patient, a 30% would indicate an $81 buy price. As always, I'm keen to hear your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button to be continually notified of these videos as they drop. And as always, we'll see you on the next one.